Share my screen. We're going to on a portion of the screen and slideshow from the beginning. Center view. All right. All right. So let's get started this evening. We're just past the bottom of the hour here. So welcome. This is another edition of Thirsty for Knowledge Thursdays, brought to you by the ARIES Foundation for Financial Education, Inc. This week, we're talking about charitable donations, but specifically more detailed, more involved with that, which we've dubbed How to Gift and Get Paid, which is all of the ways that you can benefit while giving to charity and helping those charitable organizations, causes, whatever is near and dear to your heart. Before we start up here, just to let everybody know, a little pre-flight checklist for you. The event is being recorded, but you don't have to worry about your name or your image being shown because it's only what's on the screen that is being recorded. However, your microphones are muted and your cameras can be on or off because, as I said, they're not being recorded anyway. There is a chat box, though, so if you do have questions during the presentation, please use the chat box to ask those questions. My co-pilot, who I will introduce in a second, will be fielding or making sure or following up with any of the questions that come in, but he's also there to make sure we try to get this flight in on time. And speaking of your pilots, I am Tom Alessi. I'm the president of the ARIES Foundation for Financial Education. I've been in financial services for over 21 years now. I'm an investment advisor. It means I act as a fiduciary whenever I am giving any guidance or advice to any of my clients. I'm going to bring in my co-pilot, Craig. Why don't you join us? Tell us a little bit about yourself.
Sure. So I'm Craig Richardson. I'm the vice president of the ARIES Foundation. I've been in the financial services field for a little over 16 years, and my specialty is working with families and small businesses to help them define their goals and come up with a financial plan for themselves.
Absolutely appreciate that. And Craig will be chiming in as we go along here in the presentation, but also, as I said, any questions, put them in the chat box because he'll answer them that way as well. Some disclosures before we start. First, this presentation is meant to be purely educational. You know, the information that we share with everybody, we are trying to give information. We share all of these recordings on our website, on our YouTube channel. We just ask that if you're going to share them, that you do the same, that you treat them as purely educational material. The ARIES Foundation for Financial Education, Inc. is a nonprofit. We're not affiliated with any broker-dealer, securities-related business, and we're not a registered investment advisor. We strongly, Craig and I, the foundation strongly recommend that if you ever have any questions related to tax, legal, or financial, that you seek out the help of a professional. And in the case of tonight's presentation, we're going to be talking a lot about a stuff that probably going to need to turn to your accountant, your CPA, if you're trying to take advantage of how some of this stuff works, because it does get a little bit complicated, deeper dive into stuff and whether or not you can actually take advantage or, make use of some of the deductions or some of the breaks that are out there. So we definitely counsel that you go and seek out the help of a tax professional for that. Wow, that was a lot of words for me. So I am so happy that we serve drinks on this flight. And tonight, as I had said to my partner, I am drinking something in his honor that is called Never on Time from our friends up in Vermont at the Magic Hat Brewery. It's described as a bang-up pilsner with a biscuity body and a light floral aroma. So I'm certainly excited to try this one. Craig, what are you drinking this evening?
Actually having a Cayman Jack margarita.
Wow, look at you. There's going strong right there. I am, so our goal here with this, we call these, Thirsty for Knowledge Thursday, but we affectionately refer to it as Think with a Drink, because our goal is to deliver education in an informal and relaxed, casual setting. And we can't think of a better way to do that than if we have something to sip on as we're going through all of this. So sit back, enjoy the ride, skål. Okay, so the agenda. We're going to talk about the charitable giving rules. We'll look at a couple of different ways of doing wealth transfer, as I call it, using some of the arrangements that are available whether that's an annuity transfer or just some other asset transfer. We'll touch a little bit on IRAs and what's happening as far as the RMDs are concerned. And then we're going to spend a little bit of time with life insurance, because life insurance is one of those, what did you call it? Like a Swiss Army knife, Craig? Is that what you had referred to it as? This tool that can do a whole lot of things.
Yes. Mm-hmm.
Right. And then in the case of giving to charity, there's a lot you can do, whether you have a policy or you don't have a policy. And we'll talk about that. Lastly, what's on tap? That's our way of staying with the think with a drink theme and what's upcoming for us. So let's get into that. So the CARES Act, which I know it was, COVID relief and some other pieces in terms of, bringing that up, but I'm not going to go into what the CARES Act actually stands for, was 2020. However, the new stimulus, the Taxpayer Certainty and Disaster Tax Relief Act, whoever came up with the name for that, I have no idea, because that one definitely does not roll off the tongue there, extended some of the charitable, some things that the CARES Act had in place, but specifically what we're talking about is charitable deductions, donations that can be made, right? And so the first one is it kept the above the line deduction, right? So now why is this so important? Because most of us in today's world we're not itemizing anymore because of the standard deduction. So an above the line deduction means it doesn't factor in there. It's in addition to your standard deduction. And that's $300 for a single filer, cash contribution to a charity or charities. It can be as many as you want, up to 300. It's an above the line deduction. $600
a piece.
Huh?
Like give 300 charities $1 a piece.
300 charities $1 a piece. If you so to do it that way, it's however you want to break it out. It's $300. $600 for a married couple. So this is a good thing. It's an extension of that same thing. We're not going to go into for itemizers because it's a little too detailed and much. And the percentage of the audience that probably is ever going to deal with itemizing today, this is 2021, it's probably going to be very, very limited. So we're just dealing with the above the line stuff there. Now, the second part of this says, don't try to hoodwink your uncle, right? Because here's the thing with this is you can say, hey, I made this cash contribution to a charity, but if Uncle Sam comes after you about this, the penalty has increased because they realized they were opening themselves up for everybody to say, oh yeah, I gave $300 to a charity. Sure, here's what I did. So you just want to make sure that it's something that you do. And for us, there's plenty of causes out there. I know everybody has one or a cause or a charity that's near and dear to your heart, but certainly take advantage of it because it's cash. We always talk about stroking a check to a charity. This is a way for you to do it and take the tax deduction. It's a great thing. Mm-hmm. All right, so now we're going to get into the give and get paid portion of this. And the first one we want to look at is an annuity, right? So the idea here is that you have an asset that you are going to donate to a charity. Okay, so it's a simple thing where I'm gonna donate an asset to a charity irrevocably, right? We've talked about this in the past. This is I'm giving it away. I don't own it anymore, right? It's no longer in my control. So I'm just transferring this to the charity. What the IRS says in that situation then is that I can then take a deduction, based off my giving this away. I can get this federal charitable tax deduction. There are some limitations in there in terms of how much you can actually qualify and do. Again, that's why you need that tax professional, right? In terms of going through that. But, basically what you can do is then, in the case of it, purchase an annuity to then create payments for you, and if you're married, you and your spouse, more than one person, that annuity will then pay you out for the rest of your life, or in the case of you and your spouse, 2 lives. Mm-hmm. And a portion of each payment can be offset. You can get a portion of it income tax free. So you're taking an asset that has appreciated value, you're donating it to the charity. The charity, you're taking a write-off on that. The charity's creating an annuity, which is then paying you out for 2 lives, and the charity gets the benefit of whatever's left.
So in this case, you may be, because this would probably be more of a substantial gift than the $300. This would probably be something where you'd be going into itemized deductions if you were going to be gifting in this way.
Correct. Right. Now we're getting into a little bit more deeper dive with that. Also, you'd want to have, so that this is all set up. That's why the tax and legal professional, and we'll get into that in a second, where it's going to get more involved. But yeah, because, well, in some cases, it may just be something as simple as, hey, you bought Amazon, 10 years ago, and now you've got this huge appreciated value in Amazon. Your capital gains tax is going to be overwhelming when you sell it. So you can gift off the portion that's the capital gains.
Really? Oh, the gain.
Yeah, the gain.
Okay.
Right, which gets us into the next part. Right now we're looking at this from that. So that would be an annuity. So in the charitable remainder world, they're called CRATs and CRUTs. CRAT is the charitable remainder annuity trust. A CRUT is a charitable remainder uni trust, just to follow along here. So you are huh?
So they both sound like something you just stepped in.
Yeah, I know. It's not pleasant in terms of how that sounds, but it actually works out very well for you, right? So this is the idea where you've got that appreciated asset. So again, the share of stock is usually the issue there, where you've held it for a long period of time and it's gone through the roof, and now you have all of these capital gains that you would have to deal with. So what you can do is you can donate it to the charity. Right? The IRS says, okay, we'll let you do it again with certain interest and certain limitations to that. And then you are going to transfer it to this remainder uni trust. So this charitable remainder uni trust is where you're going to put that asset, right? So then the asset is going to pay you income for the rest of your life, right? So they can actually do this in several ways, but the trustee basically has the ability to sell the asset, again, take that capital gain off the table and purchase something that would essentially pay out, almost like the annuity version of that, that's going to guarantee that there's going to be payments for the rest of your life.
So it's very similar. It's just a matter of what funds you're using to purchase it with.
Well, no, it's how you're setting up, where the annuity is just going straight to the annuity. This is where you're using the uni trust to do it.
Okay.
Okay. And so then now what you want to do as the donor, right, is you've got beneficiaries who were counting on that Amazon money, right? They wanted that money. So what do? You set up a life insurance trust, right? Otherwise known as an ILIT there, right? Irrevocable life insurance trust, otherwise known as an ILIT. The donor uses the income from the CRUT, that money that's coming back, to fund the premium payments on the donor's life that goes into the ILIT. And then the ILIT will then, that premium payment that comes over, you can basically do that through gift tax, essentially, unless it's more, but generally you can do it in terms of the gift tax exclusion. So you're not paying taxes on anything. And then what's left in the CRUT after you passed, again, that sounds terrible to say.
As I said.
But what's left in the CRUT after you pass away goes to the charity. And then the money that's sitting in the, where did that go? Oh, there we go. Okay. And then the money that's in the ILIT when you die passes to your beneficiaries, to your heirs. So what you end up doing is taking this highly appreciated asset that, if it passed to your family, would pass as part of your estate or also get taxed because of it. And now what you're doing is giving it to charity, getting income from that, taking that income, using it as a gift tax, purchase the life insurance, which then passes to your family tax-free.
So the only one who doesn't benefit here is Uncle Sam.
That is the idea. But Uncle Sam is on the board. He allows this to happen.
Ah, because we're trying to be nice to charities and orphans and widows, right?
Right. And then there's limitations in there. And again, that gets into the whole accounting and dealing with the estate planner to go through this. But for most people, you can do this.
So you're really helping multiple people with the same dollars, making it
Exactly.
dollars more.
Right. That's the whole idea behind it is using those dollars in an efficient manner, making sure that, again, if you've got a charity or cause that you're behind or, feel is really important to you, and you have beneficiaries who also need to be taken care of, this is a very efficient way to do it. With, like you said, the one party that gets left out of it is Uncle Sam.
Well, even if you want to be selfishly generous, you're getting rid of the tax from the capital gain, turning it into an income stream that then turns into a tax-free death benefit to your heirs.
Right.
So even if you weren't so generous, but just wanted to use that as a way to alleviate those taxes and pass a tax-free benefit, it's still a great thing to do.
Yep.
So even if you're Ebenezer Scrooge, it's still a good thing.
It's a way to do it. Yes. I don't know. We're back to the crut and the crat thing and not sounding too good there with the whole Ebenezer Scrooge, but yes, that's the idea. All right. So let's get into pre-tax money. So some of the things so last year with the CARES Act 2020, you did not have to take required minimum distributions. So that was a big thing with the CARES Act. So everybody who had a required minimum distribution got to press the pause button.
Mhm.
That taxpayer certainty and tax relief act thing, one of the things it did not do is it did not extend the pause button on the required minimum distributions. So this year, 2021, that light turns back on and everybody's got to take required minimum distributions. So now we're talking about how to use those required minimum distributions to benefit a charity. So one of the things you can do is you can donate the IRA asset to the charity itself. One of the nice things here is they left the threshold at the previous required minimum distribution age. That used to be 70 and a half. This goes back now to the Secure Act of 2019. It's a lot of acts in the last 3 years that have just piled up here.
Doing a lot of acting. Yes.
Yeah, so Secure Act changed required minimum distributions for everyone who has not started to take their RMDs to 72. However, for the case of donating to a charity, that remained at the same age prior, which was 70 and a half. So if you're turning 70 and a half in 2021 or in 2022, you can donate to charity. You don't have to wait till 72 to do that, which is where it used to be, right? That, the distribution basically goes directly to the charity. There is a limit on it. So it's one of those, okay, I'm doing it. Like Craig said, maybe I'm taking a portion of it and doing it, but you are going to lower a lot, even if you take a portion of it and donate it, of your taxable concerns. Specifically, the required minimum distributions that need to come out on an annual basis, and are those affecting your Social Security benefits, your Medicare premiums, everything else that goes along with that. So it's one of the things to be thinking about with that required minimum distribution coming out of your, whether it's your IRA or your 401k, because there are things you can do with that money, and we'll talk about that in a second when we get to life insurance. But just know that window that was open, they closed it for a little while, but Secure Act brought it back in terms of being able to do the donation of your IRA to a charity is open. Again, if the window is there, you can do it. And you don't have to be 72. It's just 70 and a half, whether you're taking RMDs or not.
So if I do donate my IRA assets, say 100,000, say I have $1 million in my IRA, and every year when I turn 70 and a half, I decide to do $100,000 into a CRUT. Can I do that?
So if you're donating to the charity,
Yep.
right? So that's the portion you're allowed that $100,000 limit. You can't go beyond that.
Per year, right?
No, that's at 70 and a half. You can't, it's not every year.
So to limit 100,000 annually per IRA owner isn't every year, so I can't give 100,000 a year.
Yeah, you're right. I'm sorry. I was doing,
Well, I'm just wondering, well, because the only reason I'm thinking about this is, what if
yes,
you
you
were,
are correct. It is an annual thing. I apologize. That is correct.
oh, that's okay. That's what I'm saying. Like if you were doing, into a CRUT and you were doing a stepped up annuitization rate every year or every 2 years, you could do that $100,000 donation, turn it into an income stream. The question I'd have is what would be the tax consequence on that?
Right. So that gets into a little bit deeper of
That's where you need to talk to the accountant.
you got a web going on there in terms of how much, whether or not you can do it, because then the question in that situation, does the trust end up with trust rates on the distribution?
Oh, you think you'd have to pay tax on the distribution back to us?
Yeah. So, well, somebody in that situation, unless it's all been donated to the charity, how does the charity then the charity would then have to take the distribution out, right? And whether or not they can do that. That I don't know the answer to, because that we're getting deeper into the tax accountants world.
World. Right. This is why you need a professional accountant.
Correct. That's why you need a professional to deal with that. But just
You
know
The
that
question
window,
here to ask them. Right.
and the window is open, so you can do it, and it is something that is available that you can. But more to the point, Craig, more like the annuity version of it, right, where you could donate it so the income stream comes back. I think in that situation, then you are getting the income stream, so you've got the tax base at that point. I think. I don't know how that works though.
Okay.
Okay. All right. So now we're going to go to life insurance, because this really gets into some of the things that you can do here with life insurance as far as donating to charity. So let's say you have a policy. Okay, so I've got a policy that's available. You can just name the charity as a beneficiary to your policy if you so inclined. Maybe you only had your spouse, didn't have any kids, and your spouse predeceased you. Well, you can change the beneficiary to be the charity.
Mm-hmm.
Simple, easy to do, right? You can gift the entire policy. You can just make the policy and change the owner of the policy to be the charity itself and the beneficiary, so that the only thing is that upon your passing, they're going to benefit from it. Now, one of the things with that is there is the ongoing premium payment that needs to be done for this. And so a lot of times, if you're setting that up, then there would be that annual gift of the premium to keep the policy going. So you're making additional contribution as well, which are going to then pay for the policy. In some cases, there are, permanent policies, specifically like whole life, where it's building up a cash value that, depending on how long you've had it, the dividend may be substantial amount that's going into the policy. That what you can do is change the dividend, that instead of having the dividend pay to the policy, you can have the dividend sweep out and pay to cash. And what you can do is then make the charity the beneficiary of that dividend payout. So a way to take the cash value that's building up and use it to then gift to the charity. Were you going to say something?
No, you answered my question.
Okay. All right. So that's if you had a policy. Now, what if you don't have a policy, right? So then, this is, hey, I have a policy, but I've got people who are intended, and I don't want to change anything to that. You can take out a new policy, right? And then the conversation gets back to, hey, you've got to start taking RMDs again. And how much is that RMD that you're taking? And if you don't need it, and it's just, hey, Uncle Sam is forcing me to take this money out of my retirement account, might the conversation be that we take that RMD, turn around and use whatever it is to then fund the premium for whatever it can purchase on your life for a life insurance contract that pays the beneficiary is the charity, right? In terms of the conversation with that. And then you can be giving the gift, that annual premium is a gift. So you can be gifting it, so that money's coming out, but then you're turning around and using it as a gift to the charity to pay the premium.
Right. That's if the charity owns the policy, correct?
Right, right. You want to set that up and going through that and make sure that that's how that's set up correctly.
Because the other simple way you can also give back is just if you already have a life insurance policy or setting up a new one, you can have as many beneficiaries on a life insurance policy as you should choose. So
That's correct.
if you want to do a small portion of your existing or new policy as a charitable, the charity as part of the beneficiary, you could do that. So if you had a $250,000 death benefit and you want to leave 25 grand to a charity, you would just put that in a list of beneficiaries of the insurance company.
Right, right. You can always update. That's what I was saying. You can always update or change the beneficiary, absolutely. And it's something that as people go forward in time, you might be thinking about or looking at as a way to do it. Or like I said, you know, in the unforeseen circumstance that one of the beneficiaries predeceases you, that it might be replacing them on it and you know, using those proceeds to then support or donate to a charity or a cause type of thing.
Right. Once again, this is another, we get a lot of clients and they hit their RMD requirement. They go, I don't even need it. What am I going to do with it? And they start parking it back in a savings account. And now they can get, and they can get the deduction so it doesn't hit their income tax and be benefiting somebody at the same time.
Correct. That's the idea. You know, one of the things with policy is funny, the new ones, there is actually some providers out there who have a charitable gift rider that you can add on to the policy. Now, it does come with limitations in some cases. There's a certain face amount that needs to be written, you know, like 250,000 or so on the total death benefit. But then you can put this rider on, and a lot of times the rider is no cost. You can just designate that I would like, you know, and they'll give whatever, it's like 2 to 5% to whatever charity you designate for that. And so, like Craig was saying, instead of, hey, I'm going to carve out a piece for it, I can just add this on and have this charitable gift rider added to my policy where upon my passing, that gift is going to go. Now,
that's only certain providers, right?
Huh?
That's only going to be certain insurance providers though, correct?
Correct. So you're finding more today, you know, in the last couple of years, more and more are starting to add them to it. You know, and it's funny because a lot of term policies add them, but I can't see you doing it with a term policy because, you know, that's really one of those truly unforeseen things. The number of death benefit payouts that come from term policies is very, very low. It's less than 2%. So if you're going to do it, you want it to be a permanent policy so that you know the charity is going to benefit. The other one there is this survivor purchase option, which, you know, Craig and I spend a lot of time talking to people about what we call SPO with this. But what SPO does is it gives you the opportunity to, if you're a couple, you can have policies where upon your passing, your spouse then has the ability to take out a policy. And Craig, you said it was like up to 5 times the face.
Actually, it's up to 10 times the original face amount.
Up to 10 times the original face amount. So if you do this out in terms of thinking this from I'm trying to leave a legacy to my family, but I'm also trying to leave a legacy to a charity. If I pass, my proceeds go to my spouse. My spouse then has the option. She's got a policy on her that's going to take care of the family, to then turn around, use some of those proceeds to fund a policy that she can designate to go to a charity because she's got the ability to do that. Or vice versa. I'm, you know, offering myself here in this instead of having her, you know, she's definitely younger and in better health than I am. But, you know, it's that idea. You have policies on both lives that are meant to protect the family, but you put this rider on there that says whoever passes first, the other one has the option to step in, as Craig said, up to 10 times the face amount of the original policy, that you can use some of the proceeds from that death benefit to then start funding the policy, which then can be a second policy to multiple charities, different beneficiaries, etc. We use this a lot in the special needs planning because it's a great way to then have a fund that goes to the special needs trust in that situation.
Well, it's a good way to turn, thousands of dollars a year into tens of thousands of dollars of life insurance benefit, into leveraging that into hundreds of thousands of dollars of life benefit. So it's a fantastic leveraging tool that a lot of people just don't understand or take advantage of.
Right, and that's part of it, is that whole concept of being able, as Craig said, leverage and be efficient and use those dollars to do multiple things, but to ultimately benefit that charity or that organization, where you're also then not taking away from whatever legacy you were leaving for your heirs, for your beneficiaries. This is on top of that, and definitely sets up for that. So it's definitely something to explore. Again, this has to be a new policy, so you'd have to take that out because this is a rider that has to be done at the time the policy is issued. But it's definitely worth having the conversation to see if it might be available. Which gets me into the next part, which is if you want to explore this, spend a little time with it, or figure out whether or not this makes sense for you. If you come to us and we go through and do a policy with you, we'll actually give back, we'll contribute along with you. So we'll do a donation to whatever the charity or cause that you're trying to support. Doesn't matter to us. We're open to just about supporting just about anyone. We're trying to help as many organizations as we can, but we will give back as well. That's sort of our promise in all of this, because we want to help out too, and we can do that and do that as part of it. So if you come to us with questions or concerns, go through the process, figure out, hey, I want to have one with this charitable rider on it, or I want to have that SPO rider, we will do a donation to whatever the charity or cause is on your behalf as well.
10% of our commissions, not necessarily their life insurance contribution, correct?
Correct. Yeah.
Want to make that clear.
Okay.
Like the box tops that I'm going to buy a jet. I just want to make sure.
the Pepsi thing. All right. So really, for us, it's always about trying to define and figure out the clear road ahead. Okay. So what the path is, we know for everybody, and certainly the last year has taught us the path gets convoluted, it gets cluttered. There's potholes and hazards that pop up. So we're always trying to help everybody sort of find their way and go through the process and really figure out where do you want to be and how are you going to get there. And we do that, it's through a planning process. It's the only way we know to do it. And for us, for everybody, we offer it as a complimentary process. There's no cost, there's no obligation. Our goal here is trying to help everyone have a better relationship with their money. And so if we can help you do a little bit to get you onto the right path, figure out where you want to be or how you want to be, or in this case, how you can contribute and donate to a charity, that's what we want to do. So we do request your feedback and support. We're going to send out evaluation forms. We really do like to get as much feedback from everybody as we can, how we can improve, what we can do. Like we said, spread the word, help us, get the word out there, because all we're trying to do is reach as many people and try to help them have that better relationship with their money. This is Craig and I in our more formal attire, right? When we're really being really serious, in the world. But, we really believe in a collaborative effort. And so we're always trying to reach out and support as many other organizations as we can. You'll see us out there, and we're usually in the jerseys, though we've got multiple jerseys now, Bruins, Red Sox. Never did get the Celtics jerseys. We'll have to work on that.
I don't know if we ever haven't dressed this nicely in the last year.
Yeah.
Like
it really is formal for us. All right, so what's on tap, right? Save the dates, what's coming up. So next week, we've got our launch party. This is a networking event for any of you who are not good at networking or feel that, it's something you should be doing. come to the party next week, because we're all about, trying to be connectors and help people, but in a casual and really relaxed manner and a little bit of fun. So bring something to sip on and come with us, because we'll definitely have some fun. On 5/6, we're going to get a little serious. We've got a special guest, an attorney, coming in to talk about divorce and a special needs family. On 5/13, we're going to do sell in May and go away. That is more than a pithy little, saying right now, because what's going on with the markets getting really, really frothy here might be an adage that's worth paying attention to. And then on 5/20, we're going to do negotiating your worth. Craig, any questions in the audience?
No, I think we did a great job. And I think you let everybody know too, that we did not crash the Bitcoin market. That was not us.
Yes. Yes. It had nothing to do with that, in terms of still crashing, by the way. And then
Watch our last webinar, right?
Yeah, losing footing very quickly, unfortunately. So if you do have questions, ask us. We can help with that. Reach out and go to the website, www.ariesfoundation.org, or an email. It's info@ariesfoundation.org. We're happy to help out in any way we can. We certainly appreciate it. Have a great evening. And I am going to stop my share.